Hello, and thanks for joining us today. We will be starting in just a couple of minutes at the top of the hour. Stay tuned. Okay, I see other people are joining in. We'll be starting in just another minute. Okay, well, hello, and thanks for joining us today. My name is Carol Golden, and I am the Executive Director of the NAFA Limited and Extended Care Planning Center. Today, we're going to have an overview of an important advisor survey concerning extended and long-term care. We will take questions at the end of the presentation, so please don't hesitate to list any questions or points of clarity that you may need. We have a lot to cover, so first I want to introduce our presenters. Steve Schoenveld is an actuary, but we don't hold it against him. He manages the LTC product resources and government industry relation efforts and supports the strategic developments of the hybrid product solutions for Lincoln Financial Group. For the past 24 years, he has worked across the industry with colleagues in product, distribution, finance, regulations, and public policy. Steve brings a diverse background to his work and industry leadership. Prior to joining Lincoln, he was the CFO and actuary of long-term care insurance services company and a consulting actuary with Ernst & Young. He first worked in the long-term care with John Hancock after beginning his career as a senior healthcare consultant. Currently, Steve serves the industry as a long-term care insurance section council member, as chair of the LTC industry think tank, and will be the chair of the 2023 ILTCI conference. Steve is married with 2 sons and lives in suburban Boston, where he is an elected member of his town's Board of Selectmen. Ron Hegelman has an extensive and lengthy insurance sales and marketing background that began in 1981. He has created many innovative insurance products for numerous insurance companies and served as a C-suite executive for many well-known insurance carriers. He's also a member of many insurance advisory boards and a frequent author in industry publications. Barry Fisher, this year's chairperson of the ILTCI 2021 virtual conference, which will wrap up tomorrow. And by the way, I hope you've signed up for some of the various sessions. It's been an excellent conference. Barry began his insurance career in 1976. And in the late 1980s, he began to focus his attention on the need for individuals to plan for long-term care. In 1995, He opened a brokerage general agency devoted to helping life and health insurance professionals understand and embrace long-term care insurance as a core product. In 2005, Ron and Barry formed Republic Marketing Group, the first LTCI-only IMO in the US. Barry was the co-founder of the American Association for Long-Term Care Insurance and is also a frequent contributor to national trade publications. So as you can see, we have deep expertise, and they have information that I think will be very meaningful to you. So thank you for joining us. And with that, I turn it over to you, Barry.
Well, thank you, Carol, and good morning from California. I know it's the afternoon everywhere else. Steve, maybe you want to move to the next slide. So today, what we're going to be doing is having a kind of a deep dive into one aspect of a survey that maybe some of you participated in last year. Ron and I, along our company, IceFlow Consulting, along with Oliver Wyman, put together a survey, or we conducted a survey of agents and advisors, asking them their opinions on long-term care planning. It's actually the first time in a long time that agents' opinions have been taken on, have been asked on this, on these topics. And one of the surprising results was a response to one of the questions about what would help advisors. What did they think would help them improve their sales into the future? So, and that's where we're going to kick this off. And one of the areas, in particular that we're going to zero in on is getting into the mid-market. And so what we have here is we're going to talk about the results of the survey briefly, and then we're going to talk about how hard it is to enter the mid-market for a long-term care planning product, and what some of the moving pieces of that are, including defining what the mid-market is, dealing with the governmental actions that many of you know. NAIF is very involved on the advocacy front of talking to the on various different programs, both on the state and federal level. And then we want to focus some attention on what's going on in the private sector, because at some level, whatever government's going to come up with is probably going to be inadequate. And so the private sector needs to step up to the plate. And there's been a lot of conversation about this, including from the American Academy of Actuaries, the Society of Actuaries think tank, and so on and so forth. And then we also want to touch towards the end on the role of advocacy in something that NAIF is very strong in, and how you can take a role in guiding this conversation about how we can help the middle market plan for long-term care, and what could potential private sector solutions look like. Again, please use the question and answer function of this webinar. I'll be monitoring that, and we'll definitely want to do questions and answers. So real quickly, one of the focus of one of our questions towards the end of our survey, and if you may have remembered it, it was the who is selling what to who, how and why survey. We asked advisors what they thought would lead to more future sales growth. And surprisingly, the number one response to this was expanding my market outreach to more middle market consumers. Of all of the responses, that was the number one response. And so with that in mind, what we wanted to do was talk about where we can go with that idea and what it's going to take to get there. And with that, I'm going to turn this over to Steve Schoenfeld, our house actuary, to go through some of these ideas and thoughts.
Thanks, Barry, and happy to be here. So let's start off by defining what the middle market is. And I was reviewing a proposed public policy option And as I was reviewing it, the nice thing about being home all the time now is you can multitask, like most of you are probably doing right now. So pay attention. We're going to be taking a poll now. But while I was watching this individual present, I was looking up some of the numbers. And one of the things they talked about was, the average income for most Americans. So here's the question that came out of that, and I'll share some data with you in a moment. Approximately, what is the average annual income for a 65-year-old individual? So just before retirement, and we're talking about the average annual income. So the poll is open now. You can go ahead and answer. $95,000, $85,000, $75,000, or $65,000. And if you can hum to the music you see there on the screen, very good. So we got overwhelming around 65 to 75,000. It's a good response. It's not correct, but it's a good response. We'll move on to the next poll. The next poll is, the song was Jeopardy, so if you want to hum without reading music, you can do so. Approximately, what is the median annual income for a 65-year-old individual? Now, median is middle, not average, but middle. So if we took all probably 105 million people that are working, it's the 52,500,000th person, the middle of it. Okay, answers seem to be coming in. And we've got commonality around the 65 and 55,000 number. So you're close, and we'll see in the next few slides how close you really are. All right, so before I get to those answers, I wanted to share something that's been personally pressing for a while for me. In my job, I spend a lot of time with advisors just like yourselves, with clients as well who are looking to buy coverage, policymakers and so forth, and regulators as well. And one of the things I always get frustrated about, always, is that we seem to diminish what it means to have an ADL deficiency. We seem to think, oh, it's just being frail, or it's the senior moments. Well, it's not. Long-term care policies don't pay because you've had a senior moment. They don't pay because you're just frail. They pay because you have 2 of 6 ADLs and can daily not do those ADLs. I often remind people that the D stands for daily in ADL. And things that we all did this morning just to get up and get ready for our day. Usually it's to get ready for our day going somewhere, but these days we don't necessarily go anywhere. So I don't want to be coy here or mean to make light of the conditions of claimants, but it's clear that we do tend to diminish them. And, when the advisors or the consumers or the policymakers, make light or, diminish the intensity of the need, I'll often ask them, well, just pick 2 of those. So I'm asking you, tomorrow morning, when you wake up, turn to your spouse or turn to your son or daughter or anyone around and say, I'm not going to do 2 of these ADLs today. I'm just not going to do them. So let's figure out what it's like to help. Now pick 2 of the easy ones, like maybe eating and dressing, and try not to do them. Obviously, we've all had the experience and have all seen loved ones go through this. So, but there are many that haven't. And there are many out there that think an ADL deficiency is just being a senior or being frail, but it's not. It's very intense. You need professional help. You need trained help. You can't simply just go at it alone. So thanks for giving me the 30-second there spot to emphasize that ADLs and severe cognitive impairment is really intense. And just to reiterate here, walking and moving around, even the caricatures are wrong that I found on Google. For some reason, they think walking or moving around is continence. Well, that's probably an easy way to label continence, but regardless, it's very much misunderstood what it feels like to have an ADL dependency. So let's get back to the numbers. So this is what I looked up. This comes from federal statistics. I used to have a link here that said where it was from, but this comes from basically a database of provided by the government. So directly linked to some of those bureaus out there that do this for a living. A 65-year-old on average makes $87,600 So the answer was 85,000 is close. $87,000 just before retirement. You can see how these numbers go up at 65 and then start going down because people do indeed retire. So I picked this number as being kind of a high level. This makes sense as to where it ought to be. The median is this number right here in the middle, the 50th percentile. Half the country makes 55,600 or less. Half the country makes 55,600 or more. And clearly it's skewed to the right because the higher levels of income in the 90 and 99th percentile. Another interesting thing I saw from this is that the 1% is just over $500,000. We have this view of the 1% being the Bill Gates of the world and so forth. Well, the 1% is just over $500,000. So what we're looking at is those who are retiring in the middle mass right now make $55,600 individually. That's the median point. So that's what I'm defining as the middle mass. Now let's define that based on assets that they might have. So here we have a similar data, similar source, just grouped a little differently. The average net worth, including their home, for a 65 to 69-year-old or for a 60 to 64-year-old, somewhere in the middle, is about 1.2 million. When you look at their median net worth, including the value of their home, if they actually own the home, it's closer to 250,000 if I just want to average these two numbers. So $55,000 of annual income pre-retirement and $250,000 of total net worth. All right, so when you're thinking about the middle market, the 50th percentile, and even go to the 75th percentile, where the average assets or net worth is around 775,000 there. Going back here, 100,000. We're not talking about a whole lot of money. And of course, it varies greatly because this is not done by geographic location. You're going to make more on the East Coast, New York particularly, New England particular. You're going to make less in the middle of the country just because expenses are less as well. So when individuals are developing public policy, they really have to be aware of who they're trying to make those policies for, including the amount of assets they have, if they're expected to participate either through a waiting period or co-paying for their coverage, or actually buying private long-term care insurance. How many of us would even approach someone that was making $55,000 and only had $250,000 of net worth for long-term care insurance? Would we even bother with that particular those particular numbers, or would we have to focus up here more on the 75 percentile? One other thing about the middle market is they're facing some extreme costs. So the cost of care varies greatly as well, and this is more of an indication of how it varies greatly throughout the country. So this is the Long-Term Care Group's 2020 cost of care study, and it takes the lowest home health aid for 6 hours a day and the highest. So the range is from $126 to $186 a day. The monthly cost would be anywhere from $3,800 to $5,700 for that home health aid 6 hours a day. You go into assisted living, the lowest cost in the country is around $3,500. This is based on state averages, not based on regions. So there could be something lower than $3,500, but just looking at the state averages, the highest is around $8,000. You get to that semi-private room, you're at least going to pay close to $6,000 a month. Again, there are some locations that might be cheaper, but this is a state average. Adult daycare is pretty expensive as well, at just under, probably $80 a day here, and more like $150 a day here. So the costs vary wildly across the country. They vary wildly in urban versus rural settings. The availability varies as well. So all those things need to be considered when you're talking about a public option, or when you're even talking about private insurance. I know that one of the most valuable things we see when it comes to providing help and planning for long-term care is this cost of care data, so people know what they need to plan for, which is one reason why you see lots of cost of care maps out there for use in the sales process.
So Steve, can I ask a question?
You certainly can.
So it seems to me that, you know, if we're talking about covering people in the middle market, you know, or defining a middle market, what we really need to do is for private insurance anyway, is that we need to go backwards in age and identify what those averages and medians are for people who are, let's say, 50 years old in that range, that they're still working, to be able to really define a target market for private insurance. Am I missing something here, or is that something that you would agree with?
Well, I would agree with that in many ways, because you definitely have to stop looking at averages, because as actuaries, we don't like averages. We don't necessarily, develop the pricing for our long-term care solutions by taking the average person will have a 50% chance of going on claim and use that as our number across the board. It varies by age. So clearly, income varies by age, availability varies by age, by location, even by circumstance. You've got, a 60-year-old, I'll take my own case here. When I'm 60, I'll still have 2 sons in high school. Is there a place for me, let's say I was part of the 75th percentile, to actually start purchasing long-term care at that age? Because I still have those liabilities of 2 kids in high school. So it varies significantly by income, by age, by just every case is different, as you know. And a rule set isn't necessarily the way to go in defining what the availability is for long-term care insurance for someone, nor is it the proper approach for developing public policy.
Yeah, Steve, if I may add, the thing that's important is we need to reset our goals or our purpose. When we started out in this journey about 20-something years ago, our intention was to make sure we put insurance in place for those individuals who were truly at financial risk. And of course, as the market has drifted for whatever reason, that's not the case anymore. Much of what's sold, the majority of what's sold, in fact, actually sold, is sold to folks that are more interested in leveraging dollars and certainly protecting themselves and their families. But it is not. The primary purpose of the exercise was not necessarily to make sure that they maintain a private pay status, and that's what we have to do here. And by the way, in the survey, we asked the question. When an agent or advisor goes out to make a presentation about risk here, are they trying to replace the primary or the 100% of the risk, if you will, with insurance? Or was it a conversation about partially supplementing the risk so that you could remain a private pay patient? And overwhelmingly, literally 95% of those surveyed said they understood that it was a partial risk replacement, and that's the promise for being able to adequately address issues where the middle class are concerned. The reality is we've got to find a way to reduce premium by 30-40% to be able to get into the market we want to be into. There's certainly adequate research to suggest that there's a glass ceiling on premium. And so to be able to get into that market, we're going to have to be willing to admit that a smaller chunk of the risk is what we can adequately address with what we can work with. The only way to reduce premium is to reduce benefit. So we're going to have to accept the notion that reduced benefit is really the path to get to the middle class.
Yeah, indeed. And one of the things I like about your opening slide there, it's the answer to that question wasn't, I'm going to go after more low-hanging fruit. It actually said, I'm going to take the tougher road and try and sell more to the middle market, which is very impressive. To have advisors go out there and say, yes, I'm not going to just find the lowest hanging fruit and find the leverage basically and try and place policies. I'm going to go after the tougher stuff, the fruit that's on the higher end of the tree. So that was a very inspiring slide, because it basically said, yes, these advisors are out there looking for broader markets. They're going to be tough to reach, but they're going to be able to find them. And yes, there might be some public solutions that help bring that cost down too. If we can properly integrate or collaborate with private insurance, can properly integrate or collaborate with those public solutions, but that's we'll have to wait and see on that.
Yeah, interestingly, Steve, there was an earlier question asking advisors about who they considered their market to be, and the vast majority said the affluent market.
Mm-hmm.
Clearly, there's in this marketplace there's a Willy Loman effect going on. Why do bank robbers rob banks? It's because where the money is.
Right.
But in this case, you're right. I think it was heartening that that agents want to go down market and serve more people, and it's that was a good thing. So.
Right. Okay, so so why was that kind of important? That's somewhat important because what we're seeing these days is some government solutions being proposed. And we've seen government solutions being proposed for the last decade and even before then as well. Finally, though, we're getting some proposals that involve a call for integrating with private insurance. They look for a public-private collaboration because they know that a public option can't work by itself. They tried that 10 years ago with the Class Act. It wasn't sustainable. Some say it wasn't even intended to be implemented, but whatever the case may be is, now we're talking about public-private collaboration. So there is hope that when we do have a plan out there that might be public-based, there is some opportunity for private insurance to jump on top of that, actually, to add into that. And that might reduce some of the costs because you're not necessarily worried about the entire exposure. And so it could bring the market down a bit. It could. Big C could, I want to emphasize that there's a lot to be learned yet. What we're seeing right now in some of the inside baseball right now is many of you know that Washington State has a long-term care trust program that's out there that is to be started as of January 1st next year. It'll be taking 58 basis points of tax on all income. And the benefit you'll receive is $36,000. There'll be some inflation adjustments to that $36,000 of first day coverage. It is reported to be a 3 of 9 or a 3 of 10 ADL requirement for impairment, which is very inconsistent with private insurance, as you know. In fact, it's not even tax qualified, I would say, based on that definition of what are the ADLs. But it's currently in some implementation discussions. There are some concerns of its sustainability, but it is one of those cases where it is the first front end kind of public long-term care mandatory program that's out there. There is an exception out there for those who currently or have bought long-term care insurance prior to November 1st, but some of those rules are still yet to be known. What will qualify? Clearly, it's long-term care coverage that will qualify for that exemption, but is it a certain amount of coverage? So there's some implementation things that are being worked out currently, but that's one of the government solutions being offered. There's also discussions in California for a similar approach, although those discussions have begun and are much more inclusive. They're bringing private insurance to the table as well to find ways to integrate the programs rather than keep them separate. Other states are looking at this as well. Illinois, Minnesota, Oregon, and Hawaii has perpetually looked at the issue. So there's going to be some partiality going on with individual states doing things. For example, in Washington State, if you work your entire career there and you retire at 65 with whatever income and you leave the state, you've lost your coverage. You have to retain residency in Washington to be eligible for benefits. So there's some issues there in such a program. The WISH Act is relatively new. It's being supported by Congressman Swazi of New York, of Long Island in particular. He's been talking about it quite a bit. In fact, there was a session yesterday with ILTCI that I moderated where he presented the program. This is a back-end program that has a waiting period based on your income at retirement. It could be an average of the last 5 years, something similar to Social Security. So if you have income in the 40th percentile or below, you have a 1-year waiting period. If you have income in the, let's say the highest level, you've got a 5-year waiting period to be on the WISH Act benefits. The WISH Act benefits, I think, are $3,600 a month of cash. Eligibility is the standard 2 of 6 ADLs, severe cognitive impairment that we see in the private industry. So there's an opportunity here for some collaboration. This is the first proposal that we've seen that has real collaboration as an opportunity. Question though, is it affordable? So what we've done is a little bit of modeling based on that asset and income aspect. So you see at the top line here, the 65-year-old, you see their average income, you see the 50th percentile as we showed before, you see the net worth. And then when you look at that 50th percentile individual, they have 20 months of waiting period to pay out of pocket first. So let's assume they had 4 hours a day of home health aid. They'd have to spend $62,400 out of pocket if they were to use professional care, of course, before they were eligible for the WISH Act benefits. So when you look at $62,400 of their, let's say 250 grand of net worth, or of their income at retirement, which was 55.6, I'm not sure where that 62.4 is coming from, to be honest. Remember, the net worth includes the value of their home to the extent that they do own it. They go into a facility or need a more intense home health care aid. Yes, everyone wants to receive care at home, but frankly, at high levels of ADL dependency, it's tough to receive care at home. You go kind of up the percentiles here to the 75th percentile, 40 months worth of waiting period, costing various amounts. And of course, when you look at some of these numbers, especially from the 25th to the 75th percentile, it's impoverishment before they even get on the WISH Act. And to me, when we look at programs and proposals like this, you can't just use averages. You can't simply use this column and say everyone's going to be fine. No, you have to look at the impact on individuals. And at this point in time, what the WISH Act proposes doesn't allow for affordability for someone that has a care need. Now, yes, it allows for some informal care, which we all support as well, as long as the care being provided informally is, talented care, or care that knows what they're doing in some ways.
Steve, let me ask a question, if I
Certainly.
may. I don't mean to oversimplify, but it's a salesman's curse. But let me put it this way: a layering risk is what we've always done. And the question on the table for all of us at this point is that we're gonna end up with some sort of public and private collaboration, and I think that's fine. The question becomes who's in front, who's in the back. And my question to you is, managed care only works if those care who is being managed has a personal self-interest in the success of the program.
Mm-hmm.
So which one in your mind can we get the greatest participation from those involved in the problem themselves, the front or the back?
I like the front better simply because when I answer the question, what is catastrophic to most people? It's that first 6 months of care, not the third, fourth, and fifth year of care. Vast majority of people are not going to have a claim longer than 2 years. And that claim for a year, that claim for 2 years is going to impoverish that family and that surviving spouse. So I appreciate the front end, because on the front end, you get an opportunity to actually interact early and begin to manage that care situation and leverage the informal care being provided. Most people in the country are willing to provide care for their family members. If they have family members around them, they need support. They don't need money.
Are you willing to accept that initial layer of care as universal and mandatory, as the Class Act was?
Yes, I think it's a good idea to have some type of front-end mandatory level of care for the first 180 or 360 days, and then purchase private insurance on top of that, whether it be for that first, an additional layer on top of that, or the year beyond. Because like I said, when you're looking at that 25th percentile, as you see on the screen here, a month's worth of care is going to put them in, they're going to be on Medicaid, period. The 50th percentile, they're going to be on Medicaid very quickly. And so I'd rather see 2 heads rather than 4 heads involved. 2 heads are better than 4 heads. In this particular proposal, you've got the state doing a front-end program like in Washington. You've got private insurance somewhat possibly in the middle there. You've got the WISH Act on top of that, and then you've got Medicaid on top of all that too. So you could be getting benefits from 4 different locations, depending on your situation. If you just did a simple front-end program and then went into Medicaid or then went into private insurance, that's only 2 heads. It makes a whole lot more sense for collaboration and coordination than maybe bringing in some Medicare initiatives as well to help with some collaboration of care, at least care management. That would be a good thing. It just seems more reasonable and respectful for an individual who is waiting 12 months. Someone that made $31,000 when they retired has to wait 12 months to get on the WISH Act. They're going to be applying for Medicaid anyway. So I'm more of an advocate at the front end, or at least call it what it is. Is the WISH Act Medicaid replacement? That's why the next slide we start talking about, well, okay, we've had these proposals out there for front end, for back end. Why not just fix Medicaid? You know, one of the things we always hear in this space is that, oh, Medicaid is facility biased. And of course, you have to spend down to be on Medicaid. Well, I looked this up as well as I was listening to that presentation. In 2018, 57% of Medicaid LTC benefits were home-based. It's not facility biased. Maybe in some states it is. And as we've seen the administration do so probably again tonight, they're putting more funds and money towards home and community-based support within Medicaid. That's the right call. These are the individuals who are probably not going to reach anyway with a private solution. It's in many ways, it makes sense to reform Medicaid and maybe even reduce the requirement of spending down in some cases where it makes sense, to encourage families to, to care for one another initially, have that home and community-based support. Clearly, of course, there's the Medicaid payment schedule issue. Medicaid doesn't pay sufficient for most providers already, and that needs to be addressed. But when you look at these proposals, you think about, Medicaid can be reformed so HCBS, home and community-based support, are dominant in all states. If there isn't any lengthy waiting periods to get in that home community-based program, if it can reduce some of the financial impoverishment requirements, not to help people qualify for Medicaid early, but at least to support them more when they do qualify for Medicaid. They can pay a fair reimbursement, then, is the WISH Act necessary?
Well, Steve, without getting off in the weeds, let me just ask one fast one for all the agents that are listening and trying to figure out what's in their near future. There's also seems to be lots of conversation and emphasis on expanding Medicare waiver issues, which would allow for greater home and community-based services where Medicare is involved. As you know, those exist in most states, but the waiting list is beyond most people's mortality. So my question is, and then you don't have the reimbursement issues that you do with Medicaid. If you had a preference, where would you like to bet?
I'm not sure if I have a preference. I mean, in Medicare, you have many different options with Medicare Advantage. Those programs haven't really panned out yet. They've been available. So if you have a Medicare Advantage program, you could provide some home and community-based care, but it's limited. It's very limited. And it's not promised either, because those benefits could be pulled at any time by the health insurer. I think focusing the attention on pure Medicaid LTC reform and getting it efficient, getting it home and community-based, supporting families earlier rather than waiting until they're impoverished. If they're on that track anyway, makes a lot of sense.
I guess, Steve, part of the issue, I mean, I like the notion of not having another government program to confuse people. But if you were going to expand Medicaid in this way, I mean, you'd have to have much tighter eligibility requirements, and you'd have to get the states to abide by them and enforce them. Otherwise, you could have, even more people who really could afford to do some of this stuff getting on Medicaid. So,
I mean, the one thing I always didn't like about Medicaid, and this goes back to before I was working on hybrid products, was, back when it was much more facility dominant, and we were talking about the partnership program as being a robust way for the middle mass to at least prevent that impoverishment, is that even when they use up their long-term care insurance policy, Medicaid will step in, but only if they're in a facility. So there was always some kind of inconsistency in my mind back then with partnership programs. I'm kind of glad to see the emphasis now on home and community-based care, but yes, we need to find a way so that, the safety net is truly being used for those that need the safety net. And I think if we could find a more elaborate way to address the middle mass from a private insurance perspective, we would have the opportunity to preserve that safety net for those to really deserve it. So, still, how can private insurance collaborate with such Medicaid reform? Can we reinvigorate the partnership program to be HCBS dominant as well? Why do you have to, shut down your long-term care plan in order to be partnership or Medicaid eligible? There should be some collaboration there as well. So some coverage, some private insurance coverage is good, but maybe not sufficient for the entire facility benefit that you might perhaps need based on your condition.
Right.
End of the day, though, I think the advisor should recognize that there will be some type of public-private collaboration at some point. Is it state-based? Well, there are many arguments that say state-based makes a lot of sense. State-based can be local. I mean, the WISH Act of $3,600 a month is for everyone in the country. $3,600 a month goes nowhere in Connecticut. $3,600 a month goes a lot further in Oklahoma, Louisiana, and other less expensive states. But the federal government has to treat everyone equally. So it's $3,600 across the board. Maybe state-based is more appropriate for that reason. At the American Academy of Actuaries, we've written a couple of issue briefs on this. One is already published, as you see in the link there. The other is about to be published, probably take a couple of months before we get the last edits done. But it talks about these reform proposals involving public and sometimes private programs. But one of the things we designed, even before 2016, when the link there was written, was just some criteria. So when you look at these proposals, how do you establish which one is better than the other? And we looked at, we call them the essential criteria for long-term care financing reform proposals. Is the level of coverage comprehensive? Is it going to cover a wide swath of the population? Are there comprehensiveness of benefits, or are there gaps in the proposal, whether it be a private proposal, a public proposal, or a combination thereof? Is there quality of care benchmarking, and monitoring involved? Do people have choice? Is it just one size fits all, or do they have choice? Is it just $3,600 for everyone, or can they customize their plan for their particular situation? Is it affordable? Of course. Risk management and cost control is one of my favorites, because we have to support informal care. People want to stay in the home. People want to care for one another, their family members, their spouses. They need to learn and know how to make sure that their husband or wife doesn't fall in the tub. They need support for being able to provide that level of care. And so that's critical for risk management and cost control, is that we support the informal caregiver, which there almost always is one in those situations. And then, of course, as an actuary, you have to say financial soundness and sustainability, because that's what we live by. So that was a given. That was going to be in that list no matter what we did. So this is one of the papers we've written on it. We're hoping to see that those making proposals today are reviewing this document, are addressing some of these issues, rather than just throwing something up against the wall and seeing if it sticks. Our work with the SOA and the think tank, and this is the second time I've been chair of it. I think Ron, you've been co-chair at one point in the past, and Barry, you've been actively involved. This time, this is, I think, the fourth think tank we've had over the past 15 years, maybe 20 years.
Right.
This time we're going to talk about the middle mass. We're going to go right to the heart of the matter. And we're going to focus on how care will be received or delivered by the middle market. Focus on their financial means in a similar way to what we just did a few slides earlier. We're going to focus on those likely care costs and identify what is truly catastrophic to that middle mass market. And then we're going to focus on how can we get to public-private solutioning. There are a lot of obstacles in the way. Coordination of benefits is one. It's impossible to do a public-private solution if you can't coordinate benefits between the public option and the private option. That needs to be regulatorily allowed. So that's beginning shortly, in a month or two. We'll have some focus groups to work on these 4 particular points, and then we'll have some in-person opportunity once we're able to be in person again, more than likely at next year's ILTCI conference. So yes, we are taking advantage of the fact that we're stuck behind screens, at least for a few more months, maybe, to have this discussion, but then we really need to have that in-person activity. And of course, when it comes to the SOA and ILTCI, it's all about a wide swath of the long-term care professionals that are out there. It's not just actuaries. It's not just product or underwriting or claims or regulatory. It's advisors and distribution as well. It's regulators too, and even the policymakers out there we invite to the table. We're not afraid of them.
So Steve, I have a question here from Ed. He's asking, Worksite once offered the solution to reaching middle-class clients. How can we get carriers back into that market?
That's a great question, Ed. Yes, Worksite is great. I have a Worksite product. I got it when I was 39 years old because I happened to work for a long-term care company, and I kept paying the premium, and they raised it 70%. I kept paying the premium again because it was so cheap. It still is cheap. And now it added to the hybrid policy I have. It's perfect for what I need. We do need to reinvigorate the group space, especially if it's public-private collaboration here. I think there are some opportunities to do so through using qualified dollars. I know there's been some proposals out there for penalty and so penalty-free and tax-free distributions from your 401k or IRA plan at certain ages to pay for your long-term care coverage. Those proposals have been out there for a while now. Yeah, we definitely must, whether it's multi-life or whether it's true group. I doubt it'll be true group, but some type of group coverage with, some very quick underwriting, if any at all, is necessary to really reach the masses. I mean, right now, if you look at a LIMRA study, 18% of the people have a long-term care solution. That'll surprise some, probably even surprises Ron and Barry and Carol as well. But if you add in all the hybrid products that have been sold over the years, it's now up to about 18%. That's a pretty decent number. What's the upper limit? I don't know, probably 45% maybe is the market. So we're not even halfway there yet, but it's a very good time in some ways to be in long-term care because of all the options we have that are out there. But what I'd like to see come back definitely is the group, the group market. I won't share with you what my low annual premium is, but it is definitely something attainable for the middle mass.
Yeah, I agree. The worksite has always been a place where you can take advantage of at work underwriting, if you will. So those people that are actively at work, about 70% of the impact of the mortality exercise is the fact that they're actively at work. The other thing that interests me is I constantly see on the television that I can buy $1 million of term insurance, assuming I'm in good health. That was a way back, but the point is I can get $1 million of term insurance off my telephone quickly. Well, if there's that kind of virtual underwriting, and we have actively at work, and there are, by the way, life insurance companies offering combo policies in the marketplace that are guarantee issue. Now, you're still buying a base life insurance policy, so the premiums are a little, pricey. But the reality is there are some underwriting concessions available at the work site and some very good products.
Indeed. So I'll go back to advocacy in a second. That slide, I don't want to not spend time on that, but the private sector role in this. What has worked for the middle market, we all probably will agree that the employer space, the group space has worked. We need to find a way to get back to it. I do see some encouraging signs with ways of automated underwriting right now, of underwriting without any invasive type of methods, as well as many of the hybrid products don't use that much underwriting. I like to say that we'll underwrite your product, just you keep your fluids, we don't want them. In some ways, that is something that could work in the middle market, in the group or employer setting. I've always had this question personally. Again, everything you see here is not, I'm not representing Lincoln in any of this. These are my own personal views and opinions. So I often ask myself, can the hybrid market be useful for the middle market, for the middle mass? That trade-off of life insurance or long-term care insurance or annuity product or a long-term care benefit is prime for the middle mass. They need the dual purpose product. They can't afford to spend $2, $3, $4, $50,000 and not get anything out of it. The affluent, yes, the affluent can spend $100 grand and not lose it, not lose a heartbeat of their retirement plan. But the middle mass, as we saw, they need something for every last dollar in retirement. So is there a middle market solution out of the hybrid space? Probably.
Yes.
Probably.
Steve, one of the questions we asked in the survey is an important one, and that is about 2 years ago, as you know, the hybrid companies offered more modal premium options. So you could do level premiums or paid up at 65 or 10 pay or whatever. Right. And we asked specifically, did that simply make it easier for the affluent to buy a policy, or did it actually give you greater client access, if you will, in the mass middle? And the answer was, I got to talk to a lot more people about doing something about their risk. So the premium matters, and that's one of the ways we get at the problem.
Yeah, indeed. The hybrid market has moved to 10 pay, 15 pay, pay to 65, pay to 70. The LTC rider market, the CI rider market as well has moved to lifetime pay type policies. So yeah, that definitely has expanded it. The question is, does a middle market person have a need for life insurance at age 80, 85, or 90? I'm sure they do to some degree, but do they need as much life insurance or more long-term care insurance? Or are there ways to mix that a little bit more so that it caters to their need over time? The older you get, the less you need the life insurance. If your spouse dies before you, you don't need the life insurance on you anymore necessarily. So you could push it more towards long-term care. So there's some options to think about in terms of flexible hybrid designs that will help the middle market get into these products that I think will be important. I've always asked the question, what is a catastrophic long-term care experience for anyone? Clearly it's leaving your spouse with nothing, or clearly it's ending up on Medicaid. And I'm often puzzled by what are the priorities of middle market clients. And this is where I might ask the audience for some help here. Do they have a priority for income, retirement income plan? Is there a priority for life insurance? Their priorities might be just to retain their home so they can pass it on to their kids. So thinking about what those middle market clients are looking for in terms of their retirement planning is also important. We touched on the last question already. What does a public-private collaboration look like? I definitely talked about what must be there. 2 heads are better than 4 heads, obviously. The collaboration, meaning coordination of benefits, must be there or it's not going to work. But how can advisors reach the middle market with today's product lineup? Maybe that should stay rhetorical, but I'm interested in any thoughts by either the panel or the attendees.
Steve, I let's just say I think the cupboard's fairly bare.
Yeah.
And you can't ignore the elephant in the room. We simply don't have the choices that we need in that marketplace. Much of what's out there can be brought down, if you will, to a more accessible level, but it wasn't the focus of the product, and so it was actually an afterthought for that sale. And that's not the way to get this done. The product has to focus on its market, and that's lowering the premium.
Well, and interestingly, I was speaking to a distributor yesterday, and what he's finding is, who's a big fan of traditional and combo long-term care insurance, but he's marketing more and more short-term care, because again, it gets back to that whole notion of insuring the front end of the risk, getting away from the underwriting issues, and more of that is being sold today. So maybe we need to be looking at that for some of the solution, that sort of solution as well.
Yeah, indeed. With all the options we have on the table now, it's probably the right time for a public program, whether it be state-based or federal-based, that actually can provide some benefits to most consumers that can help with their catastrophic needs, unlike the WISH Act. But let's go back to that advocacy page. I think Kara would like to talk about NAPA's advocacy efforts, obviously.
Well, I was thinking this has been an extremely interesting conversation, and not one that we often hear. And I think it's important, but one of the things that I know most of the advisors have mentioned is there's still this issue with a tarnished reputation for long-term care, which of course means that we have to continue the whole role of education. If you're not comfortable as an advisor, and it doesn't matter who your client is, but if you're not comfortable as an advisor with the entire topic of a longer tail on the risk, you're not likely to bring it up. So I think more of an effort has to be made to say, where does this fit in the middle market sales process. And you know, Steve, you touched on a couple of really important aspects that I don't often hear people talking about. When they get older, this does begin to shift from maybe one to another in their priorities. But we never market anything like that, saying, you know, if you're selling something to someone when they're 30, 40, or 50, how is it going to perform in terms of their future, their retirement, which may not look similar to what we see when we talk about retirement planning at this point, because their entire lifestyle is a bit different from ours. So I wasn't moving to advocacy so much as thinking of what I have heard from advisors as to why they hesitate to integrate this into the middle market. I don't think we always approach it from their point of view, not as the product, but what is the real effect on their relationship with that client over time as the client changes, as their needs change. So I'll be quiet so we can keep going with the other topics.
Indeed, thank you for that. I mean, one of the things that we look at these proposals, whether it's a state-based one or whether it's a federal-based one, it's important to use our advocacy efforts, whether it's with insurance trades or with NAIFA, to communicate, you know, where the holes or the gaps might be, which is why we have these conversations at the Academy of Actuaries, which is why we hold sessions like the think tank, and which is why we like to actively work with them so that together something could be built for that middle market. I'm looking forward to the think tank moving forward and really addressing the middle market needs. Will we have an answer? I can't promise you that, but we're definitely going to try.
You know, one of the bullet points you have here is what about partnership? And I know one of the attendees on today's session has spearheaded moving the Indiana partnership from the Robert Wood Johnson's model to the DRA model. So there is interest in saying, you know, what really works in terms of distributing long-term care, distributing and the impact that it can have, et cetera. So I think that especially, I know he's on this call now, I think we have some information that we should be exchanging more readily with you and with the think tank, et cetera, of people who are really have their feet on the street. They're dealing with this long-term care issue in the middle market. So I'm calling on those who at NAIFA are interested in reaching out and being heard and seeing how we can support a better program for the middle market.
Yeah, I mean, it's really critical, Steve, that the industry at least comes up with some proposals pretty quickly, because, you know, the trade associations, you know, both for the industry and for, you know, the agents, and NAIFA in particular, you know, they're actively out there doing grassroots advocacy. And unless the industry has a counter proposal to what's being offered for a strictly government proposal, there's nothing to talk about for our folks. When a legislator, or more likely a legislative aide, says, well, what's your organization proposing? We have to have an alternative here pretty quick. Otherwise, we're going to get steamrolled by the government.
Oh, indeed. We've seen proposals from the NAIC. NAIC put together a special task force on long-term care. I remember I presented, I think it was in San Diego or LA or something, but I remember presenting to that about hybrid products. And this is the first time they heard about what a hybrid product was. So the NAIC did that. You had FIO, the Federal Insurance Oversight Group, just 2 summers ago, did a similar work with all these proposals, but nothing gets implemented. I think the only thing I've seen so far, and based on some great work by individuals like Carol mentioned, a couple others that I know, more than half the states now have partnership requirements that are no longer 5% inflation. They're 3%, or even some are 2.5%. A couple of states don't even have a requirement. If all the states finally got on board and said 5% of inflation has killed the market for partnership products, has reduced the opportunity for the middle market to actually buy an affordable product that they could leverage and avoid the spend down issues, we would be in a different place now.
Yep. Hey, Steve, we're coming up on the top of the hour here. Maybe you want to go to the last slide for we can answer some questions here, but also we want to let people know that you're more than welcome to contact us at any time. And also the entire agent advisor survey is posted on Ron's and my website. It's just type in ltcauthority.com and you can download both an executive summary as well as the full survey, which I think you'll find pretty enlightening to see what agents and advisors are saying about long-term care insurance and long-term care planning in particular. So,
well, in the last minute that we have, I'd like to thank you for your time today, gentlemen, and to those who attended. If you have the ability to contact any one of our presenters, I am sure that they would welcome any information that you have. This is the beginning of working more closely together, and certainly a good use of all of our time. So with that, our time is actually up, and I hope you all have a good day, and thanks again.
thank you.
Carol,
Thank you.
appreciate very much.